Hello and welcome to the 7th episode of HSBC Wealth Masterclass, a special series that takes you through all the aspects of various investment products and also tells you how to best manage your investments. In this show, we're focusing on real estate as an asset class. We are going to address some of the most fundamental aspects of the subject that one always tends to have questions on. And to help you understand this better, we've got with us on the show Anuj Puri, who's Chairman and Country Head of Jones Lang LaSalle in India, and also Manish Sinha, who's Head of Consumer Assets for HSBC in India. Manish is going to join us on the show in just a bit, but we're going to begin with Anuj. Anuj, firstly, thanks very much for coming in on the show. Now, real estate as an asset class, would you say it is a must-have asset for any investor in India?
The way the real estate prices have stacked, particularly in major metropolitan cities, I'm not sure that the investors have an ability to buy as a must-have asset in real estate. If you were to talk about the end user, then I'm sure from an end user perspective, it's a must-have because it's an emotional decision. Every family, every housewife wants a house which is owned by the family so that there is really no long-term lease rentals that need to be paid. But from an investor's point of view, I'm not sure, given the way the prices on the real estate have stacked up, that it's going to be a must-have as a product.
Sure, but if I had to just take one step back and ask you if it had to be an asset that any individual should own, and again from the emotional aspect or the security aspect of owning a home, would you say it is an essential?
Two data that I'll give you is, one, the demand for housing far exceeds the supply. As per the government of data, by March 2012, the shortfall in the housing would be about 26 million dwelling units. So hugely inadequate supply coming up to the demand that is there. The second is, about a decade ago, the average age of a couple who was doing their first home buy was late 30s. Today, that average age is late 20s. So clearly it's representing that there is a lot more going for an emotional end user young couple who wishes to buy home at a much earlier age than what it was before. Lastly, I'd say is, also in India, we don't have really, pension schemes which really work well for private, people working in private enterprise. So from that perspective, the couple believes is that as they will continue to grow and, as they become old and they get on to, much lesser income, they need to have a shelter over their head where they're not paying lease rental, because really the government is not covering up for the pensions or, ability to cover up the medical charges, and hence they do not want an additional liability of lease rental, and thus they want their own home at a much early age.
Sure. Now, Anuj, if you just step back about 7 to 10 years, anyone who bought a home, whether it was a first home or a second home at that point in time, is sitting on a massive, return on that investment he's made. Today, you have a lot of people wanting to get into the market, wanting to buy even their first home, but get scared off simply because prices are too high. But you still have a number of people saying, I'm going to get into this market simply because my friend who bought his house 10 years back is sitting on a gain of about 300%. I myself could potentially sit on 300%. What would your advice to such people be?
So, I will divide this into two parts. One is the commercial real estate and the other is the residential real estate. On the commercial real estate, people buy it, investors buy it for lease rental. And, the return on commercial real estate on the lease rental is about 10 to 12% per annum. The appreciation, the capital appreciation on commercial, which is really the offices, is about 7 to 10% per annum. So if you combine the rental plus the capital depreciation, it's about 18 to 20%. When you move on to the residential from an investment point of view, the annual rental return on the residential is as low as 2 or 3%. So clearly from a rental investment perspective, it doesn't make sense, because you've got home loans at 11 or 12%, and you've got income which is coming out of the residential at 2 to 3%, because that's what the yields are on residential. So where does the investor make money on the residential is really on the capital side of the business. And the expectation is that on the capital side, the appreciation of the property will be anywhere between 15 to 25% every year. So when you add up the capital plus the lease rental for residential and you add up the capital and lease rental for commercial, it starts to match up. So from an investor's point of view, it could be both, but depends what your requirement is. Is it a lease rental that you're going for? Then you buy an office property. If it's a capital return that you're looking at, then you buy a residential property. Clearly from the capital appreciation, the game has stacked up over the last few years. Irrespective of whatever happened post-Lehman, we've seen the capital prices continue to stack up. So even before, say soon after the Lehman in post-September 2008, the prices came down by between 15 to 40% on residential. By 2010, they had reached the peak level. And by end of 2010, they had crossed the peak level of pre-Lehman. So clearly from that perspective, the prices, continue to stack up. So if I was a buyer, I would look at the history and I would say is the prices have continued to stack up. Yes, there was a dip, but on a long-term basis, between sort of 5 to 7 years, I have been able to secure a fair amount of return on a capital appreciation for residential properties, and hence I'll continue to invest in that. I don't think so you will go wrong from a perspective if you were to look at a sort of a 5-year horizon. If you're looking at only a 1 or 2 year horizon, then I think there is a possibility that you may go wrong because these are largely illiquid assets, and hence you cannot do investment for 1 or 2 years. You need to really stack it up for sort of 5 to 7 years.
Let's welcome our second guest on the show, Manish Sinha, who's Head of Consumer Assets at HSBC India. Right, Manish, we were in fact talking about, the factors that one needs to look at before, identifying any sort of real estate asset that an investor should be buying into, a real estate or a first-time buyer. You are a bank, so I'm asking you this question. When you have a first-time home buyer approach you, would your advice to him be that even if the price of the asset was slightly higher than what market rates are, if you can afford it, go for it, simply because it is at some level, like you did mention, and it's an emotional decision, it's an issue of some level of security that you're creating for yourself. So even if the asset were priced a little higher, maybe even 10 to 15% higher than market, and they liked the property, would you advise them to go ahead and buy it?
Yes, ultimately it's a question of personally what makes sense for you, and it's difficult to put a price to things like what the colony feels like, what the housing society feels like, to some extent even the friends, colleagues you have in the area. It should not be 10 to 15% higher than an already inflated price. So it's still a good idea to do a due diligence as if it were purely an investment decision. So look around the area and see if the micro markets around the area you're looking at are actually much higher or much lower. At the very least, it'll tell you that kind of story.
Sure. Now, talking about inflated prices, Anuj, do you believe that metro markets have at some level run their course, and that the next big opportunity, as far as an investor goes at least, is smaller towns and cities like, maybe a Visakhapatnam or a Raipur or some other towns like that?
Very good point, George, and that is what our thought was maybe pre-Lehman. That the metros have run its course, and really it's now the India growth story is going to come from tier 2, tier 3 cities. But I tell you, unfortunately, we've been proven wrong. And the reason for that is that we were being told by the commercial office space occupiers, the large IT companies, that tier 1 metro cities have become too expensive for us. And hence the cost arbitrage from outsourcing to the US and coming into tier 1 city is very little left. So we need to move into a tier 2 city where the salaries are more cheaper, attrition is lower, real estate prices are lower, cost of living is lower. Suddenly Lehman happened. Everything in tier 1 became cheaper. Attrition went down, cost of living went down, real estate prices went down, salaries became much more reasonable, as a result of which the tier 2, tier 3 story never started only. The tier 2, tier 3 story will come back. But at this moment in time, tier 2, tier 3 story is not really back, other than the top 7 cities of India.
Sure. But, Manish, as far as your experience goes at HSBC, now that the bank has a healthy footprint in the country, would you say that, home loan demand that you are seeing is in large part also being driven by smaller centers?
If you looked at absolute income levels, so as a bank or as an investor, I would always underwrite a property. I'd always underwrite the customer both, right? So I'd also look at where is the concentration of the high income people in India. So if you looked at that industry, so the headhunting and the sort of compensation industry, above a certain threshold of salary, if you have about 3,000 jobs in Mumbai, without going into the details, I am being told that that same threshold gives you only 300 jobs in Delhi. So 300 to 3,000. The moment you move outside Mumbai and Delhi, you're talking about not even 100 jobs. So ultimately, when you're talking about property growth, you're talking about people buying into it, and therefore you're talking about where the incomes are rising fastest and where is the concentration of that income. To that extent, you might say, something that's consistent with what Anuj is saying is that the growth is happening in the Mumbai and the Delhi more than the smaller cities, right? So that's kind of one side of the story. The other side of the story is, where do other industry leaders say that the demand is coming and where the growth is coming? So I've heard about a CRISIL report recently that says that outside the top cities, the next 10 cities are going to see a sale of property to the tune of 18,000 crore next year alone. Now, I don't know if that is consistent with what you'd expect to see in the big cities, but it tells you that there is a really big, healthy demand coming from the smaller cities as well. So ultimately, you need to triangulate the two and then arrive at the investment decision you need to make.
Sure. Now, when we look at property values, I don't think there's any property that you find less than 1 crore in value, especially in the metro markets. 2 crores, I think, is more the average number. Now, for somebody who wants to participate in the real estate story, we are hearing of real estate funds now being created. How does one get into a real estate fund? This is from an investor point of view, to play the real estate story.
So firstly, it's a really good line of thinking for an investor. So you're not taking a huge punt just on yourself and on your ability to evaluate, number one. Number two, it's a really good thing because the ticket size is something that you can choose. So I would say go out, look for real estate funds that are offered by lenders that you trust, and you work with an investment advisor for that. I would not say that trying to understand the funds and all the upsides and the downsides is something that a first-time investor can and even should try to do by themselves. Because ultimately, the real estate fund should be able to tell you what are the assumptions underlying a certain growth and what are the risks that you're signing up to when you take on that.
Sure. Now, Anuj, when you make an investment in debt, nobody talks about an investment time horizon because you're getting a fixed return. When it comes to equities, people say, your minimum investment horizon should be 3 to 5 years. If there is somebody who's got an investment horizon of, let's say, 7 to 10 years, would you say that real estate is by far the best asset to be in?
Definitely, George. I think, the historic data demonstrates that. That if you look over the 7 to 10 years, I think real estate as an investment class has exceeded even what the stock markets have been able to deliver. Real estate has its own uniqueness. It's illiquid, it's a pain to buy it, it's very difficult to be able to sell it. You have to be careful when you are executing the documents. You can't go out and start buying land because protecting land is a big challenge on its own. And today in India, possession is 99% of title. So you may own the title on paper, but if possession is with someone else on land, that land is almost gone from you. So it's got its own uniqueness as real estate. But if you're able to go through that and go through those caveats and challenges that are there, clearly it is the best class of asset which has given return over 7 to 10 years.
Sure. Manish, would you agree with that?
Is it absolutely the best? You have to understand your personal circumstance and the situation in which you're going to want to use the capital appreciation, which will hopefully be there at the end of that 7-year period. So some straight examples of instances where it may not be the best is, a lot of our customers are internationally mobile. For them, I'm not so sure it'll be the best, right? Secondly, for a lot of our customers, they may not want to put everything in form of equity. They may want to take a substantial portion of the ticket in the form of a loan. Now there you run into a bit of a problem. With interest rates being where they are, and if you're purely an investor, you may not get tax benefits on the interest rates. You may well find that, you know, at an 11-12% interest rate loan, if the loan is a substantial portion of the investment you're making, you may just find that the capital appreciation gets swallowed by just the service cost of servicing the mortgage. So there's a bunch of things that go into it. But yes, I would say it is one of the very good areas we'd advise our clients to invest in.
Let's get on our viewer queries. Let's bring on query number 1.
Hi, I'm a working professional with a private firm. My query is, we've been witnessing a phenomenal appreciation in real estate seen across various Indian cities over the past 5 to 7 years. Do you see this trend likely to continue?
Manish, you want to start first?
Sure. So yes, the last 7-8 years has been pretty good if you invested in most areas of real estate. So first thing to say though is it's really important for someone at your stage of life to actually separate the data from the anecdote. And unfortunately what you hear most often is the anecdote. And you hear anecdotes about the micro markets, you hear anecdotes about the best stories. So first thing to note is that even within the micro markets one hears about, the truth is actually a little bit more textured. You know, you talk about, say, in Mumbai, the South Mumbai, the mid suburbs, or indeed in Delhi you hear about Gurgaon. It's not exactly been uniformly, growing to the extent of exponential growth that one hears about. You know, even within the micro markets, you look at Gurgaon. So west of the National Highway has seen a much slower growth than east of the National Highway. But all the stories you hear about is east of the National Highway. And exactly the same applies in Mumbai, Bangalore, everywhere else. So that's number one. Now, having said that, in most of those locations, there has been a really good growth. Now, are the next 7 to 8 years likely to see the same, or are there enough markets where one expects to see that kind of growth? I would say there's a good chance of that. There are enough markets where one can see that growth. We are all talking about possibilities. So, we believe, yes, there are enough markets where it'll still be a good investment class.
Sure. Anuj, because that question does seem to be driven by this the lure of returns from real estate, and I think that's the dangerous approach to take.
Yeah. I think, George, one needs to understand that real estate is a cyclical business. So, in more mature markets, it's a 7-year cycle. In more emerging markets, it's probably a 5-year cycle. In more nascent markets, and I'll put India in the stage of nascency, given the maturity of some of the markets in the US and UK, and in relative terms, India will be in its nascency stage. It'll be an 18-month to 3-year cycle. So clearly from that perspective, I think question is very, very interesting. That, is it only going to be one way? It'll not be one way. Yes, it'll be one way, but the swings are going to be like that. So it will be a cyclical downward trend before it continues to go up. So clearly from that perspective, one needs to have a time horizon of sort of 5 years, because then you can ride the wave. So when it comes down a little bit, you're still able to ride the wave. But if you have a time horizon of 18 months to 3 years, then you're going to get caught out onto that cycle. So clearly from the young lady who asked the question, I think she needs to be aware that this is a cyclical market. It will come down. I think in India for the longest time, we only saw one way. Post-Lehman, we saw for the first time it coming down, and we're seeing that again repeatedly over 18 months in various cities, that the market is changing and it's taking a cyclical turn. So clearly from that perspective, she needs to bear that in mind before she goes out and invests in real estate.
All right. Let's bring on the second query then.
Hi, I'm 33 years old and I'm a working professional with a private firm, and I'm servicing a home loan that I've taken 7 years ago. Some of my friends are of the opinion that I should not rush up prepaying this home loan, as I have a steady job and also an insurance cover on the home loan. And instead I should deploy these savings in avenues such as equities, FDs, or even buying a second home. Others are of the opinion that I should prepay the loan at the earliest, since this is the single biggest responsibility that I have. What is the best approach in this case?
Banker needs to answer that first.
Well, as a banker and as a lender, obviously, we like good quality customers who have the ability to prepay, choosing not to prepay. But if I were to look at it from my consumer's interest point of view, bear two things in mind. The first is that if you're at, just to take easy numbers, right, if you're at a 12% interest rate and you have a 75% loan to value, you are actually paying 8% after tax just as a cost of holding the property. Now, you have to compare that against a guaranteed post-tax return of 8% that the property needs to, or so that fund needs to give you for it to make sense not to prepay. In almost all cases, it's a good idea to at least start looking at prepaying parts of the loan. So that's the first thing to look at, which is how much, how much can you get if you deployed those funds in an alternative place. The second thing to keep in mind is that 7 years into your loan, big chunks of the EMI would actually be only, well, there would be big components of it prepaying the interest rather than, prepaying the principal rather than the interest. Because you've spent the last 7 years giving mostly interest payments. From this point onwards, it's likely to be more principal repayments. So have that equation in your mind. But overall, you step back from the math, I think what you're going to find is it's a good idea for customers to look at prepaying the home loan, especially if the interest rates are where they are today and could remain that for some time.
Anuj, how would you answer that?
My thought is, George, don't over leverage. I've seen in the recent past, I think people have suffered because of, over leverage. She has a job today, who knows? Yeah. It may be that she's doing a brilliant job. It's just that something happens in the global world, and where she's employed, something happens to that company. As a result of it, she doesn't have a job. So clearly, over leveraging is not the buzzword in the market. We've seen that in the subprime. America, whatever happened was because of this only. I've got a house, I want to buy another, and then I want to buy another. Don't go down that road. Look at your capabilities, look at the capacity that you have, look at the uncertainties which do not appear today are going to happen but can happen in there. So even if you don't want to prepay, then please deploy the monies into such liquid assets that you are able to withdraw those assets easily if ever you have to repay your mortgage at a short notice. So I would be reluctant to say to people, go out and buy your second, third, fourth, and over leverage to the extent that you find problem if you suddenly lose your job.
Right, so with that, we've come to the end of this show where we've focused on real estate as an asset class. And you've heard it from the experts there that it is an asset that is pretty much a must-have, but you need to approach it with caution. It is the sort of asset that can give you exponential returns, or at least superior returns than other asset classes, should you have the patience to wait it out for at least 7 to 10 years. But it is not an asset that you can sort of enter with a very short-term horizon. You could get whacked the wrong way. With that, we end this show. Thanks very much for watching.